Today we'll spend some time with the CFO of Adani Group, Mr. Jugeshinder Singh, to talk about what are the concerns to address the concerns which had hit the market earlier this week on the concentrated shareholding pattern and the fact that there was a buzz of a ban by NSDL. Also, where is the group headed? In last couple of years, when India was deleveraging, when Indian corporates were deleveraging, Adani Group in a sense has put their shoulder to the wheel and they've really tried to create what could be called as a modern infrastructure platform. Talk about debt, companies, and are they really worried about the recent rise in stock prices? So to discuss all that and much more, let me bring on board Mr. Jugeshinder Singh. Mr. Singh, I'm going to pick it up from your explanation which came on Monday to the exchanges, which is that there is no ban on any of the FPI accounts. Even though it's a dated news, let's start with it and then we'll move forward.
Yeah, absolutely. So our clarification related to the fact that as far as we are aware, there is no restriction on the accounts of the concerned investors. Beyond that, naturally, this question is valid for those investors. But overall, Nikunj, first, good morning and thank you for the opportunity. We are pushing forward in relation to our investor management program and opening up our share register to new investors. So the case in point being, Adani Total Gas, where Adani as family, we have 37.4%, and the strategic investor plus global investors like BlackRock, Norges, etc., California State, etc., they have about 42%. So our registers are expanding. As our companies mature, we expect, like in case of Adani Ports, that it will be reflective of the wider participation by infra investors. And we are very confident that over the next 3 to 5 years, that will be achieved.
Okay. But does this concentration really bother you? There are some funds where the ownership of their holdings in Adani Group now is as high as 75 to 80%, and clearly risk management would come into place. How are you planning to address that? Can you be more descriptive?
No, part of that program is that the investment risk is for those fund managers to manage. I can't comment on that. What I can comment is that for us, we as Adani will remain. We are long-term investors. In fact, we are intergenerational investors. So we are invested for 30, 50 years. So for us, the sustainable investment is important. So we'll remain as core investors. Other than us, we will continue to expand our relationship with strategic investors like Total, like QI, and with global institutional investors like BlackRock, Vanguard, Norges, etc. And so we are not concerned by this. Our key focus remains on the underlying performances of our businesses. We have built very solid businesses, and those businesses are massively cash flow positive, high profit margins, high EBITDA margins. And in this process of last 25 years, by the efforts of our business verticals, we've been able to build India's largest infra and utility platform and one of the top 10 infra and utility real asset platform in the world. So I think it's very pleasing for us. It's a very proud moment for us to be able to say that in the infra space, top 10 global platform has emerged from India. So we continue to work on that. We'll continue to work on that aspect. We are not specifically, because we are ourselves long-term investors, we are major investors, over 60% in most of our companies. So we're not too concerned about specific concentration elements.
While you've invested a lot in the port business, in the gas business, in the airport business, you've also got a consolidated debt of over 1,25 crore. How are you planning to address that? Do you see that coming down? Do you see your cash flows increasing because large of the investment has happened?
Yeah, so we don't look at that from a group perspective. We look at a portfolio. Number you quoted is a portfolio level debt. It sits in various verticals. So we have two core areas that we invest in: transport and logistics, and utilities and energy. In the transport and logistics, which is APSEZ and our other smaller transport companies, we have a debt to EBITDA of about 3.1 to 3.3 times. And if you look at the global large port and transport companies, that 3 to 3.5 multiples is below the average. That is, we are less leveraged than our peer group at a global level. And if you look at our energy and utility platform, and you say you pick up the top 5 utility platforms in the US, then our utility platform has debt to EBITDA of 4.44 times, and the average in the US is 5 times. Now, somebody can say that 5 times the US has lower interest costs, so therefore 5 times is okay. But at 4.5 times debt to EBITDA, we are growing at over 12%, and the US utility platforms grow at between 2 to 4%. So we are below, our gearing is already less than our peers, and we are growing at least 3 to 4 times faster than our peers on a global basis.
Okay. Now, how much of your cash flow projection is likely to change, given that a lot of your businesses now are reaching a scale and size? For example, the gas business, the port business, even the airport business. Can I say that your cash flow, which historically has grown in the range of about 20 to 25%, is likely to increase? Because that's one number investors look at. Investors say one simple thing: look at future cash flows, and that is how you value assets. Because if you are into annuity business, infrastructure business, cash is the king.
Absolutely, good question. I think the what you hit on is the correct point. For us, the rate of return on asset employed is the key metric. So if you look at for example, last year, the portfolio level, our EBITDA grew at 22%. We are pretty much what we have actually, our various verticals and the leadership teams have announced in post our annual results this year. We expect that growth actually to be in line or maybe slightly higher than what we did this year. So our underlying EBITDA, underlying cash, is growing at much faster rate than, say, the industry peers. And in fact, we expect to double our free cash generation. So we are actually deleveraging as a group. So to just give you a data point, 5 years ago, and in 2015, the portfolio level debt to EBITDA was approximately 8 times. Today, it is 3.8 times. So we have halved our leverage ratios. And so that deleveraging of debt to EBITDA is continuing and will continue at a rapid rate. And this is also reflected in the credit quality. So we are the only infra and real asset platform in the country whose assets, like for example in ports, APSEZ has the same credit rating as Government of India. In Adani Transmission, in our utility business, has the same credit rating as Government of India. In fact, the underlying credit rating of Adani Transmission is higher than India's credit rating. But we are capped at sovereign because we are 100% domestic infra business. AEML, which is a distribution company in Mumbai, that also credit rating is same as India. Adani Green, last issuance we did, that credit rating is the same as Government of India. So our business's credit quality is reflective of the low leverage and conservative management style. We grow fast, but we grow fast because we have high cash flow generation.
Will the corporate structure in terms of the companies and the fact that there is Adani Enterprises at the top, will that change, or that is likely to remain like this for next couple of years?
No, Adani Enterprises is basically an incubator. So Adani Enterprise doesn't directly hold any one of our companies, which like APSEZ or Adani Transmission. They are directly held by investors and the family. Adani Enterprise, being the incubator business, it has, for example, currently our airport business is within Adani Enterprise. Our road business is within Adani Enterprise. Our data center business is within Adani Enterprise. Our water business is within Adani Enterprise. Our solar and renewable cluster, manufacturing cluster, is within Adani Enterprise. So those businesses are within Adani Enterprise. Once they achieve a certain scale and mature, we will then, at appropriate time, de-merge those businesses. They are very large businesses as it is. But overall, Adani Enterprise does not have a cross-shareholding relationship with any of our listed verticals.
We understand that your airport business is you're planning to take the airport business public. Is that true?
No, that is not anything. Overall, we do that all the time. We like all of our businesses has come out of Adani Enterprises. But our current focus is on the business itself. So airports are a very important business. We will be India's largest network airport operator with 8 airports, over 100 million passengers and 300 million non-passengers visiting our airport precincts. So it's a very large consumer business. So for our first objective is to set the business correct. That's always we focused on. That has been the core principle of our founder, and continues to be the core principle of our business, is that focus on the core element of the business. So our near-term focus of the next 2 to 3 years is to get this business set correctly to service nearly 100 million passengers, well over that over a period of time with growth, and 300 million non-passengers. So the focus remains on the 400 million consumers that will come there, safety and security, and service standards. With that, because we believe that if we do the business elements correct, then as the underlying business in airports is correct, we will look at IPO or normal demerger from AEL once the business achieves the fundamental stability that we would like to have in our infra businesses. That is high cash flow generation, poised for growth, and ability to distribute cash to shareholders.
So what is the internal hurdle rate? Is there an internal benchmark which you would say is the benchmark at which you want to run your various infrastructure businesses?
That benchmark is for each business. We have a risk-adjusted cost of capital for each one of our verticals. So ports have a risk-adjusted cost of capital, airports, roads, data center business, similarly transmission and distribution business, they all have separate cost of capital. The principle that we use is twofold. One is fundamental development and O&M excellence. Number 2 is we are committed to maintaining high credit quality, which is investment grade, sovereign equivalent credit quality of our businesses. And in relation to the second point of maintaining sovereign equivalent credit quality, we also want to invest as long as we can invest at a return greater than our risk-adjusted cost of capital. So all of our investments that we make, recently the Adani Green made a 3.5 billion acquisition of SoftBank Energy. Those kind of investments we make because we on risk-adjusted basis, that is value additive to Adani Green. And so that is above our cost of capital. But Adani Green's cost of capital is not similar to, say, Adani Port, because different businesses. So very, very focused, very disciplined to invest where we can beat our cost of capital, maintaining credit quality, and ensuring business excellence. So we never step out of these bounds.
Adani Green is the one where the price appreciation has been absolutely skyrocketing. For those who look at Adani Green, they say, look, it's a power company. If we value it in the traditional way, it's in stock where valuations have gone high. Let's talk about Adani Green. Would you say the business after the recent, what happens to the company after the acquisition which you just mentioned of $3.5 billion? Because I was coming to that acquisition.
So the Adani Green, you raised a very interesting point as to how fundamentally you should look at it. So if you will indulge me for 10 seconds. So we look at utility platform. Adani Green is part of our utility platform. So our utility platform includes 4 companies and 1 supporting manufacturing. So which is Adani Green Energy, Adani Transmission, Adani Total Gas, and Adani Power. If you look at a utility platform, as a platform level, we are growing at greater than 12% rate. Previously, we have grown even slightly higher, but let's assume we continue to grow at that rate. Then this platform, as we discussed, the debt to EBITDA is just about 4x, just over 4x. The free cash EBITDA of this platform is over $2.7 billion US. Now, the specific to Adani Green, Adani Green, when it started in 2015-16, as we started to build into this business, it was 500 megawatts. Today, the development what we are actually executing on the ground is 25,000 megawatts. So the business itself has grown 50x. Now, we don't specifically look at share prices and this, because that as a business, as a head of from this area of group's investments and working with the vertical leaderships, I don't specifically look at that. But what I do look at is what has happened to the underlying business. The underlying business has grown 50 times. And I'm pretty sure that the share price has not grown 50 times from that period. So if you see that, that is reflective of the business growth. So, and we will, with this acquisition, next year we will have close to somewhere between, depending upon which month of the year you pick, between 8 to 10,000 megawatts of operating assets. And traditional power business versus renewable power is a slightly different proposition, because in the renewable space, the resource, which is in this case sunlight, is perpetual for all practical purposes. And once we have the land allocation, so for example, we have land to already identified in early stages for up to 40,000 megawatts. Now, once we have the land, then this is basically a resource that we can use continuously. So this business is a perpetual business and currently only focused on power generation. It will actually also focus on decarbonization of transport fuel as well. So once it gets to that, so you see the growth runway of this business is much, much, much higher than what a traditional power business, conventional power business will have. This is also reflected in our investments. So our one investment, this transaction, Nikunj, that we discussed, a $3.5 billion transaction with SB Energy, which we signed, that one transaction exceeds our total investment in our conventional power business, just one transaction. So majority of our capital is going into this high growth, perpetual renewable businesses in transmission and distribution. So I think share price is one thing. The business growth itself is 50x. And that, I think, is what is reflected in the values.
So if you have to split the group businesses, let me split it into three parts. Young companies which you are incubating, which require capital, companies which are in their mid-cycle, and companies which are in their mature curve but are generating a lot of cash in terms of free flow. Which are the businesses you would split into these three brackets? I can say it again. Companies which are young companies but high growth companies where you're investing, companies which are in the mature curve which will grow higher than the average industry, and companies which are in mature phase but are generating a lot of cash.
So broadly speaking, our core portfolio, all of our companies fall into the latter two buckets, which is they are mature, generating high cash flow, but they're high growth. So we are in, and reason is very simple. We are in India. In our domestic market, India requires infrastructure. So we are in the core of what India is, what various state governments, federal government wants to do, which is to develop infra. So we are in that sector. So we will grow fast. So our mature companies, so I'll handle the mature companies. So what we call mature but fast growing. So high cash flow companies, but also growing fast, which is say Adani Ports. So if you look at Adani Ports, each mature company is one of our oldest companies, listed in 2007. Our largest, our non-Mundra port business, last 5 years grew at 38% year on year. And in that, now within Adani Ports is also the logistics business, which itself will also grow at similar rates. Now, so we have two businesses within Adani Port, which is non-Mundra ports and logistics, which over the period have grown at very high double digits. And in case of non-Mundra ports, grown at the rate of 38% over the last 5 years. So mature business, high growth, which is port. Then comes Adani Transmission and Distribution. That is also high cash flow generating business, but equally high growth business, two elements of it. Distribution business growing at double digits and transmission business also growing at double digits. So that also massively cash flow positive business and high growth. Adani Green Energy, operating assets, very, very much cash flow positive, high cash flow. In fact, excess cash flow allows us the growth that we have done. And although that business will continue to require us to invest, it will not be distributing dividends. But from 2023-24, it will. But because we have a pipeline which we announced last year of target of 25 gigawatt by 2025, which we've already achieved. So we will definitely complete at least 24.3 gigawatt. So that is a high growth business which has high cash flow, but less distribution cash because it's still massively high growth. Adani Total Gas, again, massively cash flow positive, but also high growth. It will go from 4 cities to 39 cities. So that's one block of businesses. Then we have mature business like Adani Power, conventional power business, where the growth is low and cash flow is solid for that business. The new business is where we need to invest, all are within Adani Enterprise. Airports, data center, roads, and Adani Water. That's where they are young businesses, those 4 businesses, very large businesses, but young businesses. And that's where we are investing. And we believe that roads and airports and data center are one of the key growth areas in the future for India. And so we are well poised in that area, and these businesses are well poised. So this is how I will classify. We actually do not have a business that is slow growing business in our portfolio, aside from Adani Power, conventional power.
Closing comments. We've had a very detailed interaction and understanding of the entire group structure and basic businesses. For an outsider who look at Adani Group of companies, the first question is that look, they're creating an infrastructure platform, and it's a very diversified one. But are you spreading yourself too thin, from water to airports, from managing railway stations to commodities, from power generation to power distribution? Far too many things in your portfolio.
I think it from outside might look that way because these businesses are individual businesses. But if you just, we discuss your question, it's a very, very good question actually. But if you look at it, so Adani Ports, Adani Airports, Adani Roads or Railways, they're all transport only. So they are either B2C or B2B transport business. So this is our close to what we do. We've been doing it for now well over 20 years. So closely following transport chain only. So we are not going out of the transport and logistics chain. Then you on the other side, if you come, you will see utilities only and utility and energy business. So Adani Green, Adani Transmission, Adani Power, Adani Total Gas, data center business, which is priced on power, Adani Water, they are all utilities. So which means that they are B2C or B2B, but in utility space only. So we stick very closely to what we do best, which is transport and logistics and utilities and power. Now, occasionally we'll have business that we have to set up to support these two areas, which we will do. But primarily 92% of our value comes from these two segments. And almost exclusively, approximately just close to 90% of our capex is in these two segments only. So we don't actually go outside of our known competency areas of transport, logistics, and utility and energy. Albeit there are different verticals in those space.
All right, sir. Real pleasure to have you on the show. We've been very descriptive. We've tried to simplify things for your prospective investors, existing investors, and our viewers. So fantastic to have you, and stay safe, and certainly hope to see much more of you going forward.
Thank you very much. I have 30 seconds. I just want to message for your viewers and listeners. So first, thank you for having us. Secondly, COVID has been a tough period for the country, but we have invested in this period because we believe in the fundamental capacity of India to grow. We are linked to India's GDP growth. We have invested. So with this, I want to make an assurance to public at large that India is poised for growth. We will get over this COVID period hump. But we are firm believer in the power of the Indian consumer and Indian public and Indian growth.